Welcome back to Financial Fiend. Today we're diving into the world of exchange-traded funds, commonly known as ETFs. If you're looking to understand the ins and outs of this investment vehicle and how it could benefit your portfolio, you're in the right place. This is ETFs 101. Let's kick things off by defining what an ETF is. An exchange-traded fund is a type of investment fund and exchange-traded product comprising a diversified portfolio of assets. ETFs can hold various assets, including stocks, bonds, commodities, or a mix of these, and they're designed to track the performance of an underlying index. The concept of ETFs emerged in the early 1990s, with the first ETF, the Standard & Poor's Depository Receipts, SPDR, hitting the market in 1993. Since then, the ETF landscape has expanded significantly, offering investors a broad range of options to suit different investment strategies. Now let's get into the key characteristics that make ETFs unique and appealing to investors. Number one is the liquidity and trading. ETFs trade on stock exchanges, providing investors with the ability to buy and sell shares throughout the trading day at market prices. This liquidity makes ETFs a flexible and convenient investment option. Number two is the diversification. ETFs typically hold a basket of assets, offering investors instant diversification within a single investment. This helps spread risk and reduce the impact of poor performing individual securities on the overall portfolio. Three is the transparency. One of the hallmarks of ETFs is transparency. Unlike some other investment vehicles, the holdings of an ETF are disclosed daily, allowing investors to know exactly what assets they own. And the last thing is the low expense ratios. ETFs are known for their cost efficiency, with generally lower expense ratios. Compared to traditional mutual funds, investors can keep more of their returns. Now that we understand the fundamentals, let's explore the different types of ETFs available in the market. The first one is equity ETFs. These track a specific stock market index or sector, providing investors with exposure to a broad market or a specific industry. There are also bond ETFs. These focus on fixed income securities such as government or corporate bonds, offering investors a way to add income and diversification to their portfolios. The third one is commodity ETFs. Investors can gain exposure to commodities like gold, silver, or oil through these funds without having to physically own the commodities themselves. And lastly is the sector and industry ETFs. For those looking for targeted exposure, sector and industry ETFs track specific sectors or industries within the market. Since we've covered the basics, let's discuss how you can start investing in ETFs. First one is brokerage account. To invest in ETFs, you'll need a brokerage account. Many online brokerages offer a user-friendly platform, making it easy to buy and sell ETFs. Secondly, research and due diligence. Before investing, conduct thorough research. Understand the underlying index or asset the ETF tracks. Review historical performance and consider the fund's expense ratio. The third one is dollar cost averaging. Consider implementing a dollar cost averaging strategy where you invest a fixed amount regularly. This approach can help smooth out the impact of market volatility over time. Lastly, reinvest of dividends. Some ETFs pay dividends. Consider reinvesting these dividends to benefit from compounding over the long term. Now that we've covered the essentials of ETFs, I encourage you to take the next step in your investment journey. Whether you're a seasoned investor or just starting, consider adding ETFs to your portfolio for diversified, cost-effective exposure to different asset classes. Before we wrap up, it's essential to highlight some risks and considerations associated with ETF investing. The very first one is market risk. Like all investments, ETFs are subject to market fluctuations. Prices can go up or down based on the performance of the underlying assets. 2. Tracking error. While most ETFs aim to replicate the performance of their underlying index, there can be slight discrepancies known as tracking error. Number 3. Liquidity risk. While ETFs are generally liquid, some may have lower trading volumes, potentially leading to wider bid-ask spreads. In conclusion, exchange-traded funds offer investors a powerful tool to build diversified portfolios with ease. Their transparency, flexibility, and cost efficiency make them a popular choice for investors of all levels. As you embark on your ETF journey, remember to conduct thorough research, stay informed, and align your investment strategy with your financial goals. Thank you for joining me on this deep dive into the ETFs 101. If you found this information valuable, don't forget to like, subscribe, and share with others on their investment journey. Until next time.